On my stock market tools. So today I'm doing the final tweaks to the portfolio, and then I'm writing the code infrastructure for live trading so I can start paper trading. I've decided to move forward with some of the successful strategies I have. Um, and I'm going to basically be live trading different strategies, and I'm going to weight each strategy differently. So, before I get into things, let me go over the goals for the project, what I've done so far, and that'll give you a better idea of what I'm working on today. Um, yeah, but that's basically that. So, if you're interested in the stock market, coding, quant algorithms, Python, AI coding, anything like that, be sure to subscribe and follow along because I work on this every day. And whenever I finish this project, I'm going to be working on more stock market stuff. The battle never stops, so there's always going to be more models to look at, better portfolio strategies to implement. But um, so this is kind of the outline of the model and my goals. So my first goal is beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average about 6% per year. I want to do significantly better than that, 3 to 4 times that, and go up on average 18 to 24% per year. Secondly, I want to remain market neutral. Whether the market's going up or down, that shouldn't affect the results of the strategy. I should return 18 to 24% no matter what. So, um, at the bottom is the layout. So I have data for all stocks going back to 2011. You don't want to group them all together to train the model on everything. So first reason, different things move differently. ETFs are going to move differently from things like Apple or Tesla. There's all sorts of classes of stocks. Some of the stocks included in my data set are NASDAQ test tickers, which never change in price. So obviously I don't want to train on those. I also don't want to train on anything that's low volume because that means I won't be able to scale the model up. If I'm able to get a really successful model that does well live trading over 6 months and has a really high Sharpe ratio, high percent return, then I'll be able to sell this to quant shops and get funded for the model. So the only way to get funded is if you have something with sufficient volume that you can purchase it in high quantities. If purchasing in high quantities is going to change the price, then you can't really implement this strategy at scale. And the final thing is penny stocks and low volume stocks just move differently from high volume non penny stocks. So I'm filtering out everything that's not REIT, Real Estate Investment Trust, ADR. ADRs are just foreign companies listed on the US market, and common stock, things like Apple or Tesla. So I'm filtering my universe down to those, taking the top 2,000 by dollar liquidity, and then dropping out everything that's under $5 a share to trim out penny stocks, and dropping out everything that's crashed over 50% in the last year. So that's how I'm defining my stock universe. It's updating at the first of every month. Then I'm using the universe to train a returns model. So the returns model should be predicting something like returns relative to the market, relative to sector, probability of a positive return. I actually found my best success when predicting the Sharpe ratio. And once you have a good returns model, the final step is implement some portfolio model for this. Decide how to allocate capital based on, here's the output of the returns model, now how do I allocate capital accordingly? And so that's the final level. So I've had a really good returns model for about a month. I've been tweaking it and implementing a portfolio model on it. So here's my returns model and why I think it's good. So if you look at the red box, these are the metrics I'm looking at. This is for a single model trained from 2011 through about 2019. Validated, that means tuning the hyperparameters of the optimization from about 2019 through 2023. And then it's tested from mid-23 through the beginning of 26. So if you just look at these metrics here, the first metric is information coefficient. This is giving the predictive power of the model. My goal is 0.01 to 0.02 because the stock market has a notoriously low signal to noise ratio. And you see here I'm getting a value of 0.047, so well above my threshold that I'm looking for. The threshold that defines a good model. Now, that's predictive power. These next four metrics, these next four metrics are predictive performance. So, stability. Hey, shouldn't it be better to filter out penny stocks by capping it by market cap? Yeah, that would be better. Why? So why was I originally not doing that? Oh, I might already be filtering by market cap. So let's go to Universe Explorer. I'm using Universe 7. So the filters, first I'm filtering by type. Then I get the top 2,000 by dollar liquidity. Then trim out everything below $5. Yeah, no, I think actually that's a good point. Because I'm not doing that. No, yeah, you're exactly right. I do think I need to do that. That would probably be an improvement. I'm probably dropping out things I don't have to. And probably including some stocks that are slightly over $5 that are still penny stocks. So that's a good idea. So back to why I think this model is good. So the top metric is predictive power. The next four metrics are the stability. So you want something that's really powerful, but you don't want to sacrifice stability. It's kind of a trade-off. So you want it to be stable too. So looking at the stability metrics, I want the standard deviation to be 3 to 13 times the information coefficient. The lower, the better. And you see here, this is at the bottom end of that threshold. It's about 3 times the information coefficient. Now, information coefficient to information ratio, on a daily basis, my goal is 0.03. So you see this is higher by an order of magnitude. And on an annual basis, the goal is 0.3. So again, higher by about an order of magnitude. And then the T statistic, my goal is 1.98. I'm getting 3.76, so it's about 2 times as high as my goal. So just on the metrics, this model looks really good. Now, if we look at the decile analysis, we see that the bottom decile, the bottom 10%, is the worst performing. The top decile, top 90% and above, is the best performing. And each decile is higher than the previous decile. And this is perfect for a decile analysis chart. And so this basically means that it's perfectly monotonically increasing, which is exactly what I'm looking for. So not only does this look good on the metrics, it also looks really good on the decile chart. Finally, I did a walk forward analysis where I trained a new model for every year from 2016 through 2025, using the previous 3 years as validation, and everything before that is training data. And so you see, even on the walk forward analysis, doing this strategy from 2016 through 2025, the model never dropped below an information coefficient of 0.01, which is my lower threshold. It also never came close to the threshold of 0.3. At its worst, it was about double my goal for the annual information coefficient to information ratio. So for these reasons, I concluded this was a good model, and I went ahead and tried to implement a portfolio strategy on it. And you see on this single model that was tested from mid-2023 through the beginning of 2026, it was easy to get a good portfolio strategy. Almost anything I tried gave me this nice positive linearly increasing uptrend. You can see the rolling Sharpe ratio only falls below 0 for a quick second here, and then it recovers. And so this is looking really good. However, when I try to do it on the full walk forward results, going from 2016 through the beginning of 2026. You see it fails. It goes negative from 2016 to about the beginning of 2022. It basically flatlines throughout 2022, and only since mid 23 is it really performing quite well. And you can see that in the rolling Sharpe ratio. It's going from basically negative the whole time to becomes more and more positive, and even runs up to 6 at times. So the problem now I was having was basically the portfolio is performing well at later times, but it doesn't perform well at early times. A confirmation of this is, let me find it, I think here. No, where is it? Oh, sorry, just a sec. I trained a portfolio to do well from 2016 through mid 2018. Oh, here we go. So this portfolio was trained from mid 2016 or beginning of 2016 through mid 2018. So you see in that range it's doing quite well, but after that it goes negative from about mid 2018 through the beginning of 2021, and then it basically flatlined since then. So this is the inverse problem. If I here we saw if it does well at later times, it does poorly on early times. If I optimize for early times, it does well obviously when it's optimized, but then poorly on later times. So what is the reason for this? There are two reasons really. I believe it has something to do with the macro regime. So the first thing is if we look at dispersion of the universe that I'm using over time, you see in 2020 it became significantly more dispersed. Now this is for two reasons. The first reason is that there are a lot more people coming into the market, a lot more retail traders after 2020 because of the stimulus checks, and also the rate of new stocks being listed has went up significantly in 2020. So those two things are causing market dispersion, which is basically a macro regime change. The market became more dispersed. What's also interesting that's happening in the same timeline is interest rates were notoriously about 0% throughout all the 2010s up until 2022. And in 2022, they became non-negligible. So that also changed at the same time. So I think the reason that the model's showing this performance, it does well on later years, but poorly on early years, or if it does well on early years, it does poorly on later years. I think the reason for this is one of these macro market features. So either because the dispersion increased or because the interest rates increased. So the next thing I did was look at the model. So this is from the walk forward analysis, and this is the result of every decile analysis for every year. And you see that actually not all of these, two things really. First, not all of them are perfectly monotonically increasing. But the second thing is the spread changes significantly from year to year. So 2020, a year it's having trouble doing well on, the spread is from minus 0.06 to 0.02. 2021, a year that it does well on, typically does quite well on, the spread is from minus 0.2 to positive 0.15. And so I thought, okay, maybe if I go and tweak the model a little bit, I can get a better model out. And so this model was, I used all the features that were in the previous model, but then I did an analysis on the walk forward, and I dropped out everything that was had a coefficient of variation above 1 and a mean importance below 0.05. And you see this model actually performs a lot better, and no longer does it have the problem where it does well at later times but poorly on early times, or well on early times and poorly on later times. Now it seems like it's doing well from 2016 through 2020. That looks pretty good. And it's doing really well after 2022, but it's failing during the COVID regime. So the COVID crash happens. The model actually does quite well during the COVID crash, but then during the COVID recovery, the model's getting killed. And this is commonly referred to as the trash rally. So basically, there were a lot of new people in the market. Lots of stocks were going up that really shouldn't have been, moving beyond their fair value. And so that's just a difficult regime to do well in. So I tried a new model where I found earlier, before I was doing the Sharpe ratio, I was trying to make a model predicting the returns. And I found that if I added in mean reversion and volatility features neutralized to the sector instead of the market, that actually improved the performance of the model. So I added in all those features here for the top model, and I noticed that the performance is clearly better than it was on the previous model. Then I tried doing the same thing where I keep only features that had coefficient of variation below 1 and mean importance of above 0.05. And actually the model does worse than the previous model. So I decided to go ahead with this model, model 25. And then I've been trying to backtest different things. So um, you see here, this I got a really good portfolio strategy. But this is using only volatility scaling. I'm not scaling down from anything else. So it's not scaling down from the drawdown. It's not scaling down from the information coefficient or the spread. It's just scaling down from volatility. So even though this is a simple model and I would like something more robust internal to the model that dictates the scaling, it still does really well. And it's only failing during that 2020 regime. Basically, this is a really good model. So I tried tweaking this, just changing around the information coefficient scaling to see if I could do better on the model. And I wasn't really able to. You see here, these are the results from that. So sometimes I was able to bring the drawdown lower. Sometimes I was able to bring down the drawdown duration. But you see, the drawdown duration, I never actually improved it over the base model. Here I did get a smaller drawdown. So I might go with these parameters here. Let's pull that up. Explorers, UIC look back. So what's that third data point? Wait, where did I put that? Oh yeah, portfolio.xlsx. Oh, I hope I didn't. There we go. Alright, so should be the third data point for the 0.01 threshold. So the third biggest look back distance, 40. We had a drawdown of 118, duration of 440. So what is this one where it had a duration of 300? Oh, 0.01. Yeah, so maybe there's something in here. Yeah, I don't know. 0.01 with 40-day look back gave me only an 18% drawdown, but the duration was 440 days. I like this duration better. But the drawdown's still more significant. Yeah, so anyway, the information coefficient, there nothing clearly here is an improvement. But this is with information coefficient and volatility scaling. So I tried optimizing for just 2016. That seemed like it did pretty well also. What's the drawdown duration? 337 days. Annual return 22%. Yeah, but that's a really bad drawdown there. So, hello, are you making a deep learning model? I'm not sure what qualifies as deep learning. This is a light gradient boosting method, so a tree-based model. So if I just do 2016, it does pretty well. Now I think this finished. Portfolio Explorer. $200 out of 200. So this is optimizing it from 2016. Eight longs, 8 shorts. Holding period 1 day. Rebalance days. Yeah, I don't know. Rebalance days 5. No, rebalance days 3. Wait, holding period 1 day? This doesn't make any sense. HRP look back 90. Smooth predictions false. I don't think this could be a good strategy. Buffer multiplier 1.8. Sizing method beta neutral. Target volatility's off. Volatility look back 100 days. 1 drawdown warning threshold -1. Drawdown penalty 1. Drawdown kill threshold -1. IC scaling is true. So if I get a good strategy with this, this would be really nice. IC look back. $90 days. IC threshold -0.02. Spread scaling false. Okay, so this is the portfolio optimized from 2016 through 2021. Yeah, let's see how it does. Wow, now that looks really good. I mean, that's crazy, using only internal scaling. So this will be definitely one of the models I go live with. But it is trained over that COVID region. Still getting really high returns at later years. Okay, so let's put a table in of all the models we might want. Name, description, I think that's all I need, right? So 2016 optimized. IC only. 2016 optimized. Volatility only. (2016 to 2022 optimized). All params. All scalars. So we have 2016 only, 2016 to 22 optimized. All right, so we can optimize for 2016. Optimize 16 to 22. Optimize 2020. First principles. So model 23. Let's do two first principles models. All right, so we want model 23, model 25. So model 23, model 25. Okay, so we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Portfolio strategies 1, 2, 3, 4, 5, 6. Model strategies. We can delete this column. Wait, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4. 1, 2, 3, 4, 5, 6. So we'll have 84 models, which seems like a lot, but I just want to track the performance of all of them. Um, all right, model 23 for 2026. So the name will be 23 underscore 2016 underscore internal. Okay, so I'm gonna have to build the infrastructure for this before I train the models. Oh man, how do I keep all this in one place? Um, I am gonna go grab my headphones. They should be around. I can't seem to find my headphones anywhere. I have no idea why that is. Okay, so I'm gonna make all these different model strategies. Um, Yeah, let's go through and finish naming them. So 23 underscore 2016 underscore E for external. (2026). So let's just go through and start making these. So with only varying internal parameters. So these are all the models we have to make. Model for 2026. So that means it's validated 23, 4, and 5, and then trained on all previous data. Oh, yeah, of course. Oops. No. Damn it. Alright, whatever. That doesn't matter so much. What does matter is going through and looking at these models. So I'm going to make a new PowerPoint for that. I wish I could find my headphones. I like working with headphones so much better. I'm gonna see. Sorry, buddy. Oh, I knew it. They were in bed. Okay. So, um, let's put this up here. Is there anything else I need in here? So model split, portfolio parameters determined by. So I think I need another row here. Okay, so model is 23. Model train, I'm going to leave this blank for now. Right? Because is it still splitting the data? So clean analysis. Split data by dates. Train start, val start, test end. Purge. Okay, so I'll just split by dates. So, hi, I am at work, so your stream is on mute. Anything you want to tell me, type in chat. Okay, Soulwater. Sounds good. Good luck at work. Okay, so let's train the model. Yeah, so why do I want 3 years of validation data? The model performance isn't significantly the performance of my LGBM for stock trained to predict the Sharpe ratio of stocks over the next 5 days isn't significantly different when I use 1 or 3 years of validation data. Address the obvious trade-off between validation and training data. Address the obvious trade-off between validation and training data. It is optimal to have maximum of both, but since the data is in time series format and finite, there is a trade-off between the two. More validation data means a longer distance between future and training data, and also means more validation data means both less training data and a longer distance between the future and training data. Reason from first principles and use best practices. Okay, let me cue up some music. Let me know if you have any music recommendations. Voyons surtout les toi. Alabama is juste toi et moi. Alright, so now we need a slide. Does model performance decrease if I use only 6 months of validation data? La raison. Okay, so let's put model 25 in. Alabama, rejoins-moi, regardons les étoiles, croyons surtout les toits. Alabama, regardons les étoiles, croyons surtout les toits. Okay, so then here I'll look at how much validation data do we need. I'll just say change. Okay, so I need to do that before I can really generate the models. Okay, so what I'm gonna do is I'm gonna set up this to run. So we have 3 years. At least I think that's 3 years. So let's pull up. Oh, you know what? I can tell for sure. So this is model 25. Where's model explorer? Model explorer. Test model 23 walk forward. Oh, here we go. Test model 25. So model 25 walk forward. That's pretty easy. Train end 2014. Test start 2016. So 2015 and 16 here were validations. So 2 validation years. Let's just do 6 months. And if 6 months looks fine, I'm just going to roll with that. Hopefully it will be even better. So model 25. I'm gonna have to change around the code. Wonder if I can do 0.5. All right, so let's think. What do we need to do? We have. We don't really need to test the validation years, do we? Okay, so what was that model? I'm gonna use just that one, my first good model. Okay, so let's do model 22. And I'm not gonna do the whole walk forward. So start training from 2011. Val start. Let's go 2024. Val end. Oops. No, test start, test end. So test start 2025-01-01. Test end is 2026-01-01. Okay, so first, let's use 1 year of validation data. And let's go turn on model 22. Right, model 22, yep. Okay, now let's go run Model Explorer. Yeah, so that actually shouldn't take too long, so we'll see how that does. Okay, and then once I determine this, I can decide to go ahead with the model strategies. So Alright, so what do I have to do? First to do is generate models for paper trading strategies. Next thing I have to do is generate portfolio strategies. Generate all portfolio strategies. Okay. Set up framework for a live portfolio strategy. This should update the optimized parameters if applicable. I'll put down here. Also should be functionality to recalculate models if applicable. Okay. Also should be functional. There should be functionality to recalculate the models. So set up the framework code strategy. Should run all updates and okay, so that's going to be intensive setting up the framework. Set up framework to automate data pulls from DoltHub. Okay, so then I'll have the data pulls. That'll be a script. Then I'll run a script to update the models. Is there anything else I need? No, I don't think so. Okay. Oh, yeah, I also want to start tracking what if I just buy a 5-day call on the best prediction and a 5-day put on the worst prediction. But so I want to start testing that, but I need that live framework anyway to do the tests. Oh, so this is going slow because this is still open. I don't know, this did really well though on smoothing out the issues. So let's look at maybe 2024. Hey, Siddharth Malhotra. Oh, push the code to GitHub. Well, I don't know. There's nothing really too important that I've changed that I haven't. I pushed some code last week, but really I'm still exploring stuff. One of the main tasks I'm working on though is going to be uploading the code. here it was high, so 2024, 3. Let's just put that in. Is this thing done running yet? 48. So I think it should only be doing 50, I'm pretty sure. I don't know, because on the one hand, it'll be interesting to see how this does in the paper trading. The model finally finished. So here are the features. So what was this? One year of validation data. All right, so 3 years of validation data. This is 1, 2, 3. So let's make it 22. That'll give us 3 years of validation data. Oh, but now that I've put the... Oh yeah, good, everything's closed. So let's make sure this is saved. Okay, so generate models, generate all portfolio strategies. That's just going to be tedious. All right, so we pass in the portfolio. Then let's think. What is the strategy we want to do on this? We either want to do like a general strategy, but some of the strategies will be optimized to current. So yeah, so let's think. Alright, where's this guy at? I didn't think it would take so long. Halfway there. Hey, Sakshia. Thank you. I appreciate it. Alright, I'm gonna go to the bathroom real quick. I'll be right back. Okay, good. The model finished. So here's the feature importance. Again, log ATR. 20 days is most important. Doesn't look that much different. We can check out the parameters in a second. If I depend on cider and drink. This is a walk forward. So val start instead. Let's start at 2024 0601. You got hurt at work? There is no meaningful work where I work. You mean at your job or where you live? You should be a market trader. So 25. Oh, what? Do you have a mean boss or something? Oh, yeah, well, that sucks, but really, I always think the best thing is you just keep plugging away, right? Don't you think? That's the nature of life, man. You fail and then you plug away. I'm 29 too. I'm in debt. But that's the whole thing. What are we gonna do? Give up? We just keep plugging away and someday, it works out. Just keep plugging away. That's what I say. That's my philosophy. Well, you just started a YouTube stream. Start YouTube streaming your life. I think that's what you should do. I'd watch. Get some project like this and just start streaming it. Work on it every day. Chess. Just live stream the chess thing. Start how I made a chess league. How I'm making a chess league. Watch me make a chess league. People would watch that. 25, 16, 22. I see. Current. So this needs to be 23, not 25. So here I change A to IC, change 2016 to 1622. Oh, well, that's just how people are. Some people are mean, some people are nice and fun. You know, I'd say Chess League's a great idea for a stream. I meet all sorts of people. But usually, people who are mean are just kind of narrow minded and self concerned. But they're not really mean. People, I think, usually don't like being mean. Some people do, for sure. So this is a lot of different things. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So 90 models. That kind of seems like a lot. Alright, so we just have to wait for this to finish and then I can start training the models. So let's see, the first ones, model 23 and 25 for 26, those will never change. Trained to current needs to update every day. Trained on past 3 months needs to update every day. So these guys will be easy because they're static. Oh yeah, that's true. You need a better job probably is where it starts because most of your life is spent at work. So, you know, if you have interesting coworkers engaged in, you know, that are interested and have a zest for life, life is good. If you don't, life is bad. So, oh, well, you know, that's interviews, man. You should see when I've looked for jobs. You should see my job spreadsheet. I applied last time I was looking. I wonder if I still have it. Let me see if I can pull it up. It might have been, oh, job search. Anyway, look, this is from the last time I was looking for jobs. I made a spreadsheet, put down all the jobs, the place I was applying. Look at this. Rejected, all rejected, interview and rejected, rejected, interview and rejected. Anyway, it's all just rejected. There's 3 now, interview and rejected. 2 pending, so that's when I gave up. Anyway, that's the job search, man. It's brutal. Oh, well, that's the first thing to do is to stop being jealous and helpless. Because there's always... jealous means you just want to be like them, and if you were like them, if you were rich, you would, you know, admire yourself. You'd be a rich guy, and you'd be like, I like other rich guys. So you just gotta start thinking like them. and see what do I like about those guys. It depends why you like them or don't like them. If you don't like them because they're, just they grew up rich or something, well, that's a different thing. But if it's just because they've been successful, then that's cool. It's cool to be successful. I want to be successful. I always think successful people are cool. I want to be just like that. Awesome. And every successful person, they have some point in time where they're not successful. But they all have one thing in common, which is they all have their chin up and they're all working hard, trying to get the next edge. But these models are going to be easy. They're just static. They'll be unchanging. It's all just from previous data, just same thing as the walk forward analysis. But I need to see if 6 months improves things. And actually, let's look at these. Minus 0.08. So roughly similar structure. Sharp 1.2. Oh, Sharp is worse here though. On 3 years. Information coefficient 0.03. 0.0255. So information coefficient's clearly worse. Decile analysis looks like roughly the same pattern though. So once we have, let's see, maybe 6 months will be even an improvement. But I need to know how long to train these 2026 models for. So the 2026 model will really be the 2025 model. Do a walk forward. No. Oh no, let me think about how I'm doing this. So let's look at get predictions. Now I'm worried I have a look ahead bias. So get model predictions. If not, self.model.data generated. Oh, but it's for the test year. So on the test year, we're generating predictions and seeing how it performs. So those are all valid predictions, and those are really from but the problem is 2026. I think I'm just losing the data. Oh, so this is testing in 25. So I do actually just want to train a single model. So I'll just give it 6 months of validation data. Validate June 1, 25 to 12/1/25. Train on everything else before, and then test on, say, beginning of 26. But I don't need to update the data stuff before I make these models. Okay, so this finished. Same feature is most important, that regime feature, and look at that. If it looks way better with 6 months of training data. Way better. It's basically monotonic. You see the 80th percentile, 8th decile, is lower than the 7th decile, but oh, sorry, the 9th decile, I mean, is lower than the 8th decile. So that looks much better. It's the only one where the highest decile is at the top. And actually, 3 years, the max was 0.02. Here the max is 0.04. Here the max is 0.06. So that's a lot better. So I might have to use 6 months of validation data as a standard. Anyway, these models will be easy. But now I have a question of, do I want to redo everything with just 6 months of validation data? But then I'm going to have to rewrite the walk forward code. Let's see, but today's Wednesday. So really my goal is to have everything done by, say, probably Saturday, maybe Sunday. But I want it to be ready to go for the 1st of next week. Then I could start 4 weeks of paper trading. Paper trade from 6, 7, 8, 9, 10. So from the 11th, then 18. Then the first week ends 11, 12, 13, 14, 15. Then second week ends 22nd. Third week ends 29th. 30 days has September, April, June, and November. So 29th, 30, 31, then 1, 2, 3, 4, 5. So I'll be done June 5th, 6th, 7th, and June 8th I'll be ready to go live if I can have all of this done by Monday. So, oh, I forgot. Let's look at the metrics. Oh, 0.04 for the information coefficient. So this is excellent. It seems like it will definitely give an improvement to the model. So I need to add some to-dos before I get ready. So let's actually put it down here. Before I can generate the models, I need to, whatever, I'll put it above. So before I generate the models, I need to determine optimal time period for validation is number 1. Number 2, redo analysis of portfolio strategies with walk forward trained with lower validation time. No, I didn't ask my brother about it. I want to cheer myself up for a long time. Well, that's the problem with work, is work can really cheer you up, but then sometimes if it doesn't, then it gets you down and it's the thing that used to make you happy. But you just gotta, that's why you gotta be interested and have your foot in multiple things. Whenever something gets you down, you get into your other thing that makes you happy. You need a bunch of things. You need to have your hands in all the pots. No, I didn't ask my brother though. I will. But I haven't seen him. Okay, redo analysis of portfolio. Okay, and then now let's set up. Okay, I need to determine the optimal time period first. So, okay, that will be next stream. I've been going for over 2 hours now. So, that's it for today. Thanks a lot for watching. If you're interested in this, I work on it every day. So, subscribe to follow along. I'm hoping that I can go live trading starting on next Monday morning. And then I'll do, sorry, not live, paper trading, live paper trading, whatever. And then I'll do that for 4 weeks. Um, and if the results are good over 4 weeks, so I'll be creating all these models. Then I'm gonna all these different strategies. It's gonna be 90 different strategies, which is a lot. But I'm gonna monitor all of them, their live performance over a month, and then I'll kind of weight them according to whatever's doing well. So, anyway, that's it for now. Thanks a lot for watching. Have a good rest of your day. Adios.